interesting mind speak. It was a fascinating session, and I think we all learned so much about the UK property market. Richard, let me turn to you. Can you just tell us what is the investment case? Can you just give us that answer?
First of all, we're risk adverse. So our whole strategy is to reduce the risk as much as possible and to work the arbitrage between the cost of funds and the yield on a property. That's the basic core case scenario, the strategy. Where it's slightly different from what we used to do before, which was absolutely vanilla, working the arbitrage between the cost of money and the yield on a property, is we look for buying properties which have a shorter unexpired lease term. So in other words, where we would have something of 20 or 25 years unexpired, which I would say was as bomb-proof as you could ever get, we actually try to look but at a very low yield because the risk is so small. Where we've tried to increase yield, and with that comes a measure of risk, is you buy shorter leases. But to mitigate that risk, and the risk, of course, is if the tenant, and in our case we look to government as the main core tenant, fails to renew the lease, what is the alternative use of that property? And I think, as we said during our Mind Speak, we look at the worst case scenario. First of all, we'd never borrow more money than the vacant possession value. In other words, there's no tenant, nothing's happened. It's been a real problem, and God forbid that should ever happen. But where the alternative use of the property is concerned, and is worth at least what we paid for it, if not more, because it has other opportunities, we looked at to mitigate that risk, if that makes sense. But in having conquered that problem, we get the benefit of a higher initial yield because we bought a shorter lease. And that provides two main opportunities. First of all, you're getting a higher income during the period of the unexpired lease, which is quite nice to be able to pay as a dividend to your shareholders. But more importantly, it provides us the term and the time to renegotiate that lease, what we call in the industry re-gear. We re-gear that lease onto a long-term basis so that we can then capitalize on the value of the longer lease, and actually we call it a mature property at that stage, sell it and actually return some of the profit from that sale, or that profit, to the shareholders as well.
This is the special dividend payout.
It's what we call a special dividend,
yes.
Correct, yes. And that's why it's a long-term hold.
Yeah. Mark, if I can turn to you, what I find is a lot of people, you have all this expertise, you've been in the market all these years, you've from age 24, Richard from, I think in the early 80s is when you made your switch into real estate. Patrick, of course, this has been your bread and butter all your life. People will sometimes say, well, we can go and do this ourselves.
There's no problem with people going to do it themselves, and the good news is they are frequently the people we buy the stock from. Because if you're going to do it yourself, you can only tend to do it in a small scale way. If you're an individual, you don't get many individuals who can go and buy £100 million worth of property. And you then don't have the dynamics of having a large portfolio to work with and be able to spread your risk and your unexpired lease term over the course of several buildings. There are plenty of institutions who go out and buy this stock, and they buy it as annuity stock because it's so bulletproof. But of course, the institution buys it because it is selling annuities for 10, 12, 15 years. When it gets under the 12-year period, they don't actually want it then because they're not selling the same quantity of annuities for 8, 9, 10 years as they are for longer periods. So those stocks come onto the market. So there's a big dynamic of movement in the stock. And all we are seeking to do is actually look at one very small part of it and capitalise on that by A, providing a bulletproof core dividend, and B, by providing an opportunistic top-up dividend which comes in when we re-gear the leases.
Patrick, you're spanning both, Kenya, the UK. You've been in the UK, in the Kenya property market all these years. You have a tremendous feel of what's happening. The story behind St. Paul's wanting to list in Kenya. Why don't you tell us what really, in your mind, what is that about? I mean, obviously promoting Kenya as a capital market centre, but is there a pool of capital you feel that you could tap into here?
I think the estimators, the commentators, have always underestimated the amount of money there is here and the appetite for investment, which is one of the reasons why Kenya has been able to build so much, and Nairobi's been able to build so much, and it's been readily taken up. I've been in the market, I'm afraid to say, for 57 years. I have great faith in it, but I do believe that diversification, risk mitigation, says it's very sensible for the bigger players in particular to take some of their money into a different market. It's a fairly basic investment decision, isn't it? And I think the attraction of London, which is well known, trusted, and where borrowing costs are less than remunerative rates, must be a sensible and attractive thing to do.
You made a lot of that about the carry, basically the fact that you're getting positive carry in the UK and negative carry here. Can you just go through that again, that point, because I think it was an important one that might have been missed.
Well, I think I made 2 points. The first is it's extremely difficult to buy grade A property here from the people who already own it. You walk in to the owner of a decent shopping centre and say, can I buy that on an 8 or 9% yield? He's going to say, no, you can't. Why don't you offer me 5 or 6? At which point it's pretty unattractive. So his alternative is to go developing, which of course carries developers' risk and everything that goes with it. But on the financing side, as someone who has advised large-scale developers here over many years, the dilemma is all the same, always been the same. How do you borrow at 16% and invest at 10? The answer is you can never borrow more than 15%, and you'd better believe in levitation of rents, which has so far happened. I should explain, the average commercial lease here is 6 years, and it carries a 10% compound increment. So if you can survive the first 2 or 3 years, you're okay and you can begin to service debt. But it can be very nervous while that's going on, whereas here you can put your money in and the gearing works in precisely the other way. And I would have thought people would sleep well at night for that reason.
And if I can turn back to you, Richard, and say, you're talking about renting out to the UK government. It is rated AAA. Whereas if you compare it here, I mean, they're very. Would you say that people don't have the equivalent corporates renting these properties, do they? So the strength of the covenant is materially less strong, isn't it?
Well, that's correct. Actually, I ought to correct the AAA rating, which I've been readily attributing to the British government's Treasury bond. It's not. It's AA+, which is just one notch under AAA. That's just for the sake of accuracy. But you're right. It's the strongest covenant we can possibly get, I think. Yeah, it's all covenant-led because that covers our risk aversion, and it covers our model. I would not do this model on the basis that, say, it was in Kenya, that the tenant was, dare I say it, perhaps Barclays Bank, because Barclays Bank Kenya, which might be bought by Mr. Diamond, I don't know, I've heard all these rumours, does not hold a AAA or AA plus rating of security. But that's why, if you bought a 50,000 square foot building in Coventry, for instance, let to the British government for, should we say, 10 years unexpired, you probably get it at about 8% or 7%. About that mark. But that's the government as the tenant. And here, if you did it to Barclays Bank, I don't know, Patrick, probably nearer 12%. Or there's a very big arbitrage.
Yeah,
between
there
the
is
two.
an arbitrage, but if you're the developer and the owner of the first let, yes, you can probably get about 12% on your cost.
Well, there you are. You see, that's a risk which we're not prepared to take.
Yes.
That's fundamentally goes against our strategy. Does that make sense?
It does. No.
We look for real comfort. We want security of income.
Yes.
As a secure, progressive dividend to our investors.
Yeah, but I have to add, to get that 12%, you've got to take the development risk.
Of
try and buy
course
it.
you do, and we're
If
not
you try and
developers.
buy it.
We're not developers. We're vanilla investors.
That's right.
That's the point.
That's where I'm trying to get to. Yes.
Yeah.
Well, 8 to 9% exit, and there are many people saying 7.
Right. So I mean, when you make that comparison, it's a credit arbitrage in a way.
But I don't
isn't
want
it?
to be boring, Aly-Khan, but one of the things we tend to forget straight away
Yes.
is it's all very well saying you're going to get a higher yield, even from, say, Barclays or, I don't know, the Kenya government, perhaps. But you've got to pay tax on it.
Yes. Take us through that.
You
Because,
don't have to pay,
yeah.
because of the tax transparency between the UK and the Isle of Man, which happens to be an offshore jurisdiction, and St Paul's is an Isle of Man company, although it does have a Kenya branch for compliance purposes. It is incredibly tax efficient, because the surpluses from your rent that you get in the UK from your government tenant tends to be very near your net. All right, you have to pay our fees, and you've got to pay some legal fees and some surveyor's fees, but they're not onerous. They're sort of part and parcel of what you'd expect in the package of that sort, and they're international standards. But that's the only, and you probably have to pay those fees here as well. So they're probably
let me
they're
come
probably
back
the same.
because you said you were charging 1%, and
Yes, we
and-
are probably paying more somebody here. I appreciate that.
Yes, because some of what we've seen here were considerably higher. So even the yield you were talking about,
You've got to make those deductions.
but the deductions that we've seen in a couple of listings recently were what I found very high, about 400 basis points in one case.
I couldn't possibly comment.
Yeah, but I'm just saying yours seemed to me to be very aggressively priced, and you were aligned with the investor, because if you make some windfall gains, that's when you get some windfall
I think
gains.
that's the difference. We
Yes.
need to keep the lights burning. Our shareholders we're not asking our shareholders to pay more than to actually keep the fundamentals of the business running. We get our gain, don't we, Patrick, from performance.
If I can chip in there, the reason why I'm sitting here is because my own experience of trying to promote REITs is they are very, very expensive under Kenyan legislation.
I think that's the point I was trying. Now, you were here when you were 3 months old. You were born here, I believe.
Oh, yes.
Yes. Patrick,
I came here when I was 8 years old.
when you were 8 years old. So besides that emotional connection, which is obviously very strong, we all feel it. I came back 9 years ago because I felt it. What is driving the listing, Richard, here?
I'm not really. I thought it pretty obvious what's driving
Yeah.
it, and that I see that there's an enormous pool of wealth here,
Yes.
and a lot of the pool of wealth I don't think has actually been declared. I think there are a lot of people who are very private, and I appreciate that. I think particularly the institutions, and some of the institutions that I've met here, in fact, virtually every single one of them, hold their fund managers and their committees, their investment committees, are very wise people and very clued up, and that gives me huge comfort. It's so much easier to talk to somebody about, I say DNAs and all of us, especially all of us Africans, but it's really quite nice for us to be able to talk to somebody at institutional level, let alone high net worth individual level, who knows exactly what we're trying to do. We're not reinventing the wheel here. This is actually one of the most boring strategies God put on this earth. It is boring, I'm sorry. I don't want this to be, there's no bells and whistles and glitter to this story whatsoever.
Some people are saying, look, we're a small third world country, money is going out to the UK. How do you respond to that?
With great ease, isn't it?
Yeah.
This is called diversification. Kenya has been free of exchange rates, I think, since the 80s. I can't remember exactly,
since
so
the
forgive
80s.
me,
Yes,
but
it
about
is,
the
yeah.
80s, which makes it one of the most sophisticated nations in Africa. There's none of all these premiums. Look at Johannesburg, look
Yes.
at South Africa, where they've had all these premiums and all the things, and we had them in the UK. We used to have a foreign exchange premium, sterling premium. But it's not happened in Kenya. So it's obviously going to be one of the most attractive hubs, and it's in our face. It's not a question of trying to invent or think about. You tell me what other nations who have the sophistication available in Nairobi, both in management terms, professional terms, that's property people, lawyers, surveyors. We have in Kenya a fantastic opportunity to be the springboard for investors from Uganda, from Rwanda, from Tanzania, from why not South Africa? You put up a graph of the swing between the
Did you see that?
the rand and sterling.
It was a one-way trade.
It's extraordinary.
Yeah.
Now, of course, you're right.
And
But
that
if you'd been a net rand investor,
Yes.
you'd be looking pretty sick.
That's right.
All right. If you actually hadn't invested, you'd have had the perfect perfect hedge against your currency.
Yeah.
Here we have a much more stable currency. Of course it fluctuates, every currency fluctuates. You made a very good point, Aly-Khan, that sterling fluctuates. And we're going through certain things at the moment which exponentiate that whole problem. I mean, Brexit but in simple terms, Kenya understands the UK. We feel comfortable with each other. So, why not diversify into a market where you feel comfortable?
Mark, do you think we have a chance to create a center of excellence for capital raising for real estate here in Nairobi? If you look at, there seems to be a lot of movement now. We got REITs, income REITs, D-REITs, St. Paul's PLC looking to list. Is this an opportunity for Kenya Inc. to be a financial center?
I think it is. We look on it as the first time, really, that Kenyans have been given the opportunity to do this. If they've been investing abroad before, it's been piecemeal, it's been small, and it's been fraught with problems of getting their money back here from English public companies. Now, if it is going to develop, and we believe it's going to develop, otherwise we wouldn't be here, quite frankly. So let's say when it develops, it has got to develop on a more international stage. You can only build to a certain level on internal fueling. It's done a lot of that. I mean, I was with Patrick last night and we were talking about the development in Nairobi, in shopping centres and commercial space. It's phenomenal. It's an enormous percentage increase year on year. And of course, you need to do that to get the ball rolling. But when that ball is rolling and the profits are coming in from that, you've got to look to preserve those profits. And to preserve those profits, you've got to look a little bit more globally. And you've got to start looking for other markets, and you've got to start looking to layer out your layers of risk. And one of the ways of doing that is to put it somewhere else. This way, you can invest in Kenyan shillings, in Kenya, but the underlying asset is somewhere else. So you just have the comfort of knowing that if all the eggs in this basket fall out, that one's not going to. It's a good, stable platform to build a portfolio on, whether you're an institution, a high net worth individual, or quite frankly, somebody just planning their pension.
I'd go further than that, if I could, actually, Aly-Khan, and say this is actually a structure which would be, I would have thought, of great interest as trusts, private trusts. Where you're actually building up a portfolio for your grandchildren, or on an annuity basis, or indeed for your own pension fund. There's no difference.
Can I come back to 2 points? If you look at that South African company that bought you out, what year was Redefine? What year was that they bought you out?
It was in 2008.
So, in retrospect, it was quite a smart transaction by them because of the rand sterling rate, right?
Absolutely.
Yeah. So, I mean, that was also a sort of a defensive measure by them to protect themselves against devaluation, right?
Yes,
There
I'm not
was
sure
sort of
they
partly a hard currency hedge.
Very much so, but I'm not sure they anticipated, or they're a very, very clever and very grown-up bunch of people in Redefine. I have nothing but huge respect for them. Perhaps they didn't anticipate the fall in the UK commercial property market as much as actually happened between 2008 and 2010.
Which comes back to another point you were talking about, timing. And, being a trader, and timing is everything. Everything. I mean, how would you describe you being such a good timer?
Well, I think that's very flattering, Aly-Khan.
Well,
I'm not too sure I have been. I'm an old timer.
There are not many people who timed it.
Well, in fact, I wish we'd done this in last year, because the market has definitely improved in the UK without a shadow of doubt in the last 2 or 3 years. I didn't have the idea 2 or 3 years ago. It was only when I explored the opportunities in Kenya did I actually wake up to it. And I was too close to the cliff face, if that makes sense. But if I moved back from the cliff fence, and we've done something now, and I think in the most appropriate timing we can. It was unfortunate that we had to pull the November issue.
Yes.
But that was actually purely because the markets here were not favourable to this kind of investment.
And if I can just remind everybody, around that period, Treasury bill rates, 1-year Treasury bill rates surged to 23%. There was a lot of uncertainty. There, the Imperial Bank saga, so I think it was a sensible decision to do it then, to pull it. I think a brave one as well, to defer it to hopefully in the very near future. So just to give some context to the situation that was pertaining at the time, we've now seen it stabilize. Interest rates have come down, and we've seen a much more stable environment, which is, I hope, conducive. Mark, what is when what we're talking about is portfolio diversification theory, the idea that you don't put all your eggs in one basket. This is what I think the selling prospect to people is. Plus, it's got a pickup over UK government bonds, which is really substantial, about 500-600 basis points.
Basically, I mean, the 10-year bond is about 1.5.
Yes.
It's about 1.5. So actually, the spread over bonds is quite colossal.
Yes.
The interesting thing about it is that when you actually do a net-on-net analysis against returns that you might get from a comparable-based property investment in Kenya, not that there is completely comparable, but let to Vodafone is probably comparable. Yeah, they're called Vodafone in the UK. If you look at those, actually the difference, especially if you net off, there is no difference. Actually, you're getting virtually the same yield. So what we're actually offering is somebody who can layer their portfolio with a highly secure layer. Not all of it. Nobody wants everything in one basket, but just there as the base layer. Just like when we're building our property fund, we build it with a layer of very secure properties and then add the opportunistic on. If somebody over here is building a portfolio, there's nothing wrong with them having the same, and that could just be could start off with a few 100,000 shillings. It doesn't matter. It'll build over time, but they should build it in a structured way, and of course they can do that very easily through the securities exchange, buy and sell.
That's right, and it's liquid. You can get in and out.
You can get in and out.
Yes, that's right. Patrick, what are the risks?
In St Paul's,
Yes.
the risk is very simple. If the managers get it wrong and their well-oiled intelligence causes them to buy properties where there is no lease renewal and no alternative user. But the whole basis of the approach is diversity through numbers, and make sure you don't buy one property because you think it's a racing certainty. You buy 7 or 8, and if one goes wrong, well, you can be a philosopher. The risk has to be non-renewal of short leases.
Yeah. Would you agree with that, Richard?
Absolutely.
Yeah.
Patrick's got
Yes.
the nail on the head to perfection.
And that's why people are looking to you to manage it, because that's your expertise in managing that kind of risk.
I hope so, yes.
Yes, I think when you built business, billion pound business on the back of that knowledge.
That's true.
Yeah.
When we actually look at these properties, and I just want to stress it is the only risk, because if they do renew, there isn't any risk. The government as a payer of rent is not at risk. So the only risk is non-renewal. So all we have to do is mitigate that risk. That's what's so important. I explained a property that we had in Portsmouth. Now the interesting thing about that property is I went out and talked to a colleague of mine who has about 30 or 40 Holiday Inn Expresses throughout Britain. And I said to him, would you like to buy one in Portsmouth? He said, yeah, Portsmouth's on my list. Well, he'd pay us more than we could get with the government in there. But it suits our purposes to actually renew to the government, but that's an alternative use. So what we've got to do is mitigate the risk should it occur. So we don't buy in the middle of green fields. We don't buy things that have no alternate use. We only buy things that we can actually put an alternative use into. And with the new government directives in these development rights, which are now enshrined in the law, you can convert to residential without a planning consent from your commercial.
Is that right?
Yeah, and that's just been confirmed in the last week as in the law. So it came in initially as a 3-year trial.
Yes.
And now it's been accepted. So you don't have to get planning consent. I can take a building let to the government and I can turn it into flats.
So really, even in the event that the government does not renew, there are other options.
Always other options.
Yes.
Otherwise, we won't buy it. That's what the core is, and that's
Yes.
where the clever bit comes in.
Patrick, would you like to add anything?
Well, you ask about risk. The other
Yes.
one, which has come round a couple of times in conversation, has been what about sterling depreciation against the Kenya shilling? Because there has been a short-term effect after the Kenya shilling stage of recovery and Brexit worried England or Britain. The reality is that if you take a long-term view, I don't think anybody would bet against sterling when it comes to its comparison with the Kenya shilling. All I know is that when we started Knight Frank, actually it was when we moved into our new offices in the year 2000, I think there were 100 Kenya shillings to a pound. And I think there are now about 150, it could be a little less.
140.
It's been a bit higher, it's been up to nearly 180 at one stage. But the long-term trend will reflect the differential in inflation, and Kenyan inflation is still running at 5 or 6%.
Correct. And I think actually, as I was saying in the session, this is an opportunity, it's an entry opportunity because of the uncertainty around Brexit to get in at a much better price. Like you said, Richard, if you look at it in October, November versus today, you know, you've got a much better entry level for investors effectively.
That was undoubtedly the best benefit we've got from actually deferring the issue in November.
Yes. Can I ask you for your final comments, Richard?
Oh, well, that's kind of you.
Thank you.
I remain incredibly excited about the opportunity available for St Paul's particularly, but I would do, wouldn't I? I founded the company with Mark,
yes,
and we've got some really good guys alongside us, very good professionals. I think we're very fit for purpose. I think we're niche. We're a centre of excellence, and I think we are, as I keep hammering home, a risk-adverse, diverse investment in property, which is so in the DNA of all us Kenyans, that is opportune and probably time for them to think about wider audiences, or horizons, as I called it.
Mark, any final closing comments?
Yes, I'd just like to say that we think it's a very exciting opportunity for Kenyans in particular. That's why we've come here. We think your market's right for it. We think your institutional and your private investors' appetite is right for it. And we think that what they need is what we can provide, and that is a secure dividend income base to any good portfolio.
Fantastic. Gentlemen, thank you very, very much. A really inspirational session. So much information. We're deeply grateful. Thank you all. Thank you. Thank you. Thank you very much. It's been a great pleasure. No, it's very much been mine.